Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Bond ETFs, your guide to smart fixed income investing. Interest rate risk. Bond ETFs are sensitive to interest rate changes. When rates rise, the value of bonds within the ETF typically drops. Why? Think of it like this. If new bonds offer higher yields, the older ones with lower yields aren't as attractive, leading to a drop in price. This can be a real issue if you need to sell your ETF during rising rate periods. On the flip side, falling rates can boost the value of bond ETFs, as older bonds with higher returns become more enticing. For those managing an investment portfolio, keeping an eye on interest rate trends is crucial. Credit risk. Credit risk centers around the possibility of bond issuers defaulting on their payment obligations. If a bond within your ETF stops paying interest or cannot repay the principal, it directly impacts the ETF's value. While government bonds generally have lower credit risk, corporate and high-yield bonds carry higher levels due to varying corporate health and economic conditions. Consider this risk like lending your money to a friend. How confident are you that they'll pay you back? Understanding the credit quality of the bonds within your ETF can help gauge this risk and plan accordingly. Liquidity risk. Liquidity risk in bond ETFs involves the ease of buying or selling without affecting the bond's price. Although ETFs generally offer more liquidity than individual bonds, not all bond ETFs are the same. Less popular or niche ETFs might have fewer buyers, making it harder to sell when you want. Liquidity can dry up, especially in turbulent markets, leaving you stuck with an ETF you can't easily offload. It's akin to trying to sell a rare collector's item. There might not always be a buyer ready at your preferred price. Be mindful of the trading volume and market conditions when considering liquidity risks. Understanding these risks is key to making informed decisions with bond ETFs. They help you gauge where potential challenges might arise and how you might tackle them head-on. Bond ETFs versus individual bonds. When it comes to investing in fixed income securities, you might find yourself choosing between bond ETFs and individual bonds. Each option has its perks and pitfalls, and the right choice depends on your financial goals and preferences. Below, we will dissect these two investment types by looking at their costs and management styles. Cost comparison. Analyze the costs associated with both investment options. Investing costs can significantly impact your returns, so it's crucial to understand how bond ETFs and individual bonds compare. Bond ETFs. Expense ratios. Bond ETFs typically come with an expense ratio, a fee for the fund's management. These fees are usually low, ranging from 0.1% to 0.50% of your investment annually. While the fees are modest, they can add up over time. Trading costs. Buying and selling bond ETFs involves paying brokerage commissions, although some platforms offer commission-free trading. The frequent trading of bond ETFs can also lead to spread costs, the difference between the buying and selling price. Efficiency. Bond ETFs provide cost efficiency by pooling investor money to buy a diversified set of bonds, spreading the cost across the fund's shareholders. Individual bonds. Transaction fees. Buying individual bonds can incur higher transaction fees compared to bond ETFs. These costs might be rolled into the bond's price or added as a separate fee. Holding costs. While there are no ongoing fees like expense ratios, holding individual bonds might involve custodial fees, particularly if held within a managed account. Purchase minimums. Individual bonds often require a minimum investment, typically $1,000 or more, which can limit accessibility. For budget-conscious investors, bond ETFs may offer lower costs and easier market access. However, those with specific needs may justify individual bonds' upfront fees for tailored investments. Management and maintenance. Discuss the management differences in terms of maintenance and transaction. Managing your investments differs significantly between bond ETFs and individual bonds, impacting both the ease of management and the level of control you have. Bond ETFs, professional management. Fund managers actively manage bond ETFs. They select and rebalance the bonds to align with the fund's goals, saving you the legwork. Ease of trading. Bond ETFs trade on stock exchanges. You can buy or sell them quickly during market hours, providing liquidity and ease of access similar to stocks. Flexibility. With bond ETFs, it's easy to adjust your exposure to different types of bonds as economic conditions change, thanks to the wide selection of sector-specific and maturity-focused ETFs. Individual bonds. Direct ownership. You own the bond directly, allowing you to hold it to maturity and avoid interim price changes. This can offer peace of mind if interest rates fluctuate. Custom tailoring. Individual bonds allow you to pick specific maturities and issuers, giving you control over credit risk and interest rate exposure. Maintenance. Managing a portfolio of individual bonds can be more labor-intensive. It requires tracking maturity dates, coupon payments, and issuer creditworthiness. While bond ETFs offer a hands-off approach with instant diversification and easy trading, individual bonds give you precise control and direct ownership. The choice hinges on whether you value hands-on control or prefer the convenience provided by professional management. Regulatory considerations. Investing in bond ETFs involves navigating a set of regulations and tax rules that can impact returns. As with any financial product, understanding these considerations helps you make informed choices and avoid potential pitfalls. Here we focus on the regulations by the SEC and the tax implications for bond ETF investors. SEC regulations. The Securities and Exchange Commission, SEC, plays a crucial role in overseeing bond ETFs. The SEC's regulations are designed to protect investors and ensure transparency and fairness in the investment market. Here are the main regulatory aspects you need to know. Disclosure requirements. Bond ETFs must provide detailed disclosures about their holdings and investment strategies. This ensures you're informed about what you're investing in and any associated risks. Periodic reporting. ETFs are required to regularly update their financial statements and holdings reports. This transparency allows you to track your investment and make adjustments as needed. Liquidity rule. The SEC mandates that ETFs maintain enough liquidity to meet redemption requests without impacting the market. This helps ensure you can buy and sell ETF shares without dramatic changes in price, even during volatile times. These regulations aim to create a level playing field, allowing you to invest in bond ETFs with confidence. They also help maintain an orderly market where information is accessible and reliable. Tax implications. Before diving headfirst into bond ETFs, it's wise to understand the tax implications they carry. Taxes can affect your overall return, and knowing how they work with ETFs helps you plan better. Dividend taxation. Bond ETFs often pay dividends in the form of interest income, which is typically subject to federal income tax at your ordinary tax rate. Depending on your tax bracket, this can have a notable impact on net returns. Capital gains tax. Selling your bond ETF at a profit might trigger capital gains tax. The rate depends on how long you've held the shares. Short-term gains are taxed at a higher rate than long-term gains. Tax-exempt options. Some bond ETFs, like those focused on municipal bonds, may offer tax advantages. Interest from these can be exempt from federal income tax, and sometimes state and local taxes too, offering a potential boost to after-tax returns. Understanding these tax nuances can help you maximize your investment efficiency. It's like tuning an engine. getting the settings just right can lead to smoother performance and better outcomes in the long run. Future trends in bond ETFs. The landscape of bond ETFs is evolving, shaped by both market dynamics and investor needs. As we look ahead, several key trends are poised to influence how these investment vehicles operate. We're seeing shifts in technology, economic conditions, and investor preferences that are creating new opportunities and challenges in the market. The rise of smart beta bond ETFs. Smart beta ETFs have been gaining traction in equity markets, and now they're making their way into bonds. These ETFs don't just follow traditional indices, they use alternative strategies to select and weigh their holdings. By focusing on factors like credit quality or interest rate sensitivity, smart beta bond ETFs aim to outperform traditional passive funds. This approach can cater to investors seeking a more tailored exposure to the bond market without delving into actively managed funds. Increased focus on ESG and green bonds. Environmental, social, and governance. ESG investing isn't just a trend, it's becoming a mainstay in investment strategies. Bond ETFs are increasingly including ESG criteria, appealing to those who want their investments to align with their values. Green bonds, which fund projects with environmental benefits, are part of this movement. The rise of ESG and green bonds in ETFs reflects a growing demand for investments that are both financially rewarding and socially responsible. Enhanced use of AI and big data. Artificial intelligence, AI, and big data are transforming the financial services industry, including bond ETFs. AI can help in analyzing vast amounts of data to optimize bond selection and weighting strategies. This technology improves accuracy, potentially leading to better returns compared to traditional methods. The use of AI in bond ETFs represents a shift towards more cost-effective and efficient fund management. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.